As we enter the heart of earnings season on Wall Street, it's safe to say we're definitely dealing with a schizophrenic market, up one day, down the next day, but the bulls and bears continue to fight it out, with the bears winning more rounds recently than the bulls. Treasury yields, not inverted anymore, but definitely flat. The Federal Reserve, I want to congratulate you on doing everything you wanted to do, and all it took was 1/4 point rate hike. And the real estate market, I have a question for my realtor friends. What is up with all these $50,000 price cuts on $3 million houses? I just need to ask. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. I hope you're having a great week. So the stock market, we are in the midst of earnings season. It's been very volatile lately, as we know. That is typically a sign of a top, uncertainty. Bulls and bears continue to fight it out, with the bears winning more rounds recently than the bulls. But I do want to talk about the stock market in general and how it's tied to our general mood and sentiment as an economy and as a country. The stock market at the end of the year 2000 had a total market cap of $15 trillion, 1-5. At the end of 2021, the stock markets all had a collective market cap of $53 trillion, almost 4 times what it was 2 decades ago. That is a huge sign of wealth creation, and if you wonder where that wealth creation went to, it's called inflation. Housing prices since then, price of cars, price of everything since then, can almost be tied to the stock market going up so much. Now that said, the stock market being worth $53 trillion at the end of 2021, stock market is worth more than our national debt as a country by about 60%. And it's more than our gross domestic product as an economy, as a country, by that same margin, about 60% higher. So the stock market is essentially the most powerful thing about our economy and the global economy, for that matter, because as we know, it's been the TINA trade, TINA standing for there is no alternative, for the last decade or so than the U.S. stock market. And we will see how things go. I can say that the Federal Reserve does have their eye on the stock market, because that is a tell on future inflation, and I'll get to that in a little bit. Treasury yields lining up. They're not inverted anymore, but they are flattening out. There needs to be a natural spread there to keep them away from inversion. As we know, that's a sign of a recession to come. They're flat. They might as well be inverted. Nobody really knows what's going on right now, but we do know the consumer is a little bit confused, and sentiment and confidence is a little bit down, so we might see these yields re-invert themselves in the next few months. Taking a look at the Federal Reserve, I want to congratulate the Federal Reserve on an incredible, amazing job that they did. Only 1/4 point rate hike did everything they needed. The rest of what they needed to do happened by them talking up interest rates, real interest rates on mortgages, for example, and also talking down the stock market. And I'll tell you this, when you look at the indexes, the Dow, the S&P, the NASDAQ, you'll see them down, 8, 12, 19, 21% for the NASDAQ at some point yesterday. Within slightly less than or in correction territory, or slightly less than or slightly into bear market territory. Those are the indexes. If you take a look at some of the individual issues, you'll see some of them down about 50%, 60%. These are high flyer, well-known names. What this basically has done is the Federal Reserve has stemmed the inflation that will be caused by the frothiness of the stock market. And what I mean is this: if somebody bought a stock for $100 at the beginning of 2020, and it went to $300 at the end of 2021, well, now it might be back to $120, and that wealth that was created has also been destroyed, which the Federal Reserve knows exactly what they're doing, as they know sentiment and confidence is going to play a big part into our problem that they have right now, which is inflation. So the Federal Reserve, with a 1/4 point rate hike, has talked up the bond market, talked up real interest rates for people every single day, and they've also talked down the stock market, which is essentially a destruction of wealth, which is going to take the frothiness off of inflation. In the real estate market, I can tell you this, a lot of our clients have a lot of stocks, and they don't feel that happy anymore selling them to go put that down payment down on the second home or something. So this all plays in together. The Federal Reserve literally talked up interest rates and talked down the stock market. Both of those two things are going to curb inflation to a certain degree, even though I think they're tackling core inflation in the wrong way. I don't even have a suggestion for them, but I know that raising mortgage rates on the consumer isn't going to tackle food and energy. But we will see the Federal Reserve in 2 weeks from now figure out what trajectory they're going to continue down, and we'll see how the markets react to that. Now, that said, the real estate market, I do need to ask my realtor friends. I'm in this nearly 20 years now. I have never seen $3 million homes take price cuts of $50,000. And I can understand if it was $3 million, $20,000, and you wanted the under $3 million crowd that searches online to find your house. But we're talking literally 50 grand on $2,950,000. Now, that's not really a price cut. What I think it is, and I need some confirmation on this, is these weird little price cuts may be a sign that sellers and their agents are now willing to negotiate by kind of throwing that flag out there of the weird little price cut. Now, the real estate market itself is more needs-based today, much more needs-based than it was just a year ago, which could have been luxury-based and people just wanting to move. But it is now a more needs-based market, which is going to curb and stem some of the inflation in housing prices. And the best part of the housing market, as always, in my humble opinion, is the mortgage market. Still, even at these elevated rates, very liquid, and it's very healthy because it is alive and it is well, unlike 2008 to 10. But there is still a huge disconnect right now when it comes outside of somebody's primary residence when we're pulling pricing on second homes, investment properties, and units. So, as we go in the next couple weeks, we're going to see the Federal Reserve do what they're going to do. We're going to see the markets react to it. And we're definitely going to see the housing market take its cues in the next month or so for the setup for the rest of the year. That is my show for this week. I hope everybody enjoyed it. Again, as always, if you have any mortgage or real estate related questions, please don't hesitate to reach out to me. Have a great rest of the week. Thanks so much for watching.